Hi newbies! Can you believe that we already arrived at lesson number 9 of our Forex Basics series? Just one more lesson to go and it will become ready to begin Forex trading. Now, let's get started. In the last lecture, we talked about risk management. In here, we will focus on position management. In Forex trading, a position is the amount of currencies that an individual owns in his or her Forex account. Position management is how you manage your positions in your trading account. Let's consider this scenario. Lisa wants to long USD to CAD currency pair because she believes that this currency pair has the potential to go up 1,000 pips. She has $10,000 in her account and the leverage rate for this currency pair is 100 to 1. Technically speaking, she can use all 10,000 margin in her account to long up to 10 lots of the currency pair. She is pretty confident in this trade and wants to proceed with longing 9 lots. The question is, should she proceed? The answer is no. Why? Because this will very likely trigger a margin call. A margin call is a call from the broker to demand you to add more margin deposit into your account in order to maintain your open position. For most brokers, you receive a margin call when your usable margin in your account becomes 0. Say Lisa really proceeds with the trade. She opens 9 lots of the USD to CAD currency pairs. The use margin in her account is $9,000. The rest, $1,000, is the usable margin at the moment. You could also think of this $1,000 as the maximum loss that Lisa can bear before she receives a margin call. Why? The reason can be explained by the net asset value or NAV. Net asset value or NAV is the total value of an asset less liabilities. When you have a position in your account, NAV will fluctuate as the currency pair moves up and down. NAV equals to the balance of your account plus the unrealized gain or loss. Accordingly, the usable margin equals to NAV minus used margin. In Lisa's case, if the market later moves against her and the loss gets to $1,000, she will receive a margin call. This is because NAV equals to $10,000, the balance of her account, minus $1,000, the realized loss, equals to $9,000. And accordingly, her usable margin now equals to $9,000 minus $9,000, which is 0. Because she opens a very large position size, that is 9 lots, even less than 20 pips, that is 1,800 Canadian dollar movements against her, could trigger the margin call. And in reality, this is very likely to happen. So what happens after Lisa receives her margin call? Unless the market suddenly moves in favor of her, Lisa should either deposit more money into her account or close some or all of her positions immediately. Otherwise, the broker will keep sending margin calls. If the market keeps moving against her, the broker might later be forced to close all of her losing positions. This is the stop-out process. Some brokers will set the stop-out level almost at the margin call level. Some might set at a percentage, for instance, 5%. This means when your NAV reaches 5%, the broker will start closing all of your positions. You may want to consult with your broker for the details of their stop-out rules. In general, stop-out process is a situation that you should avoid because it is very likely you will end up closing the position at an unfavorable price and lose a lot of money. As newbies, it is important for us to avoid margin calls and stop-out process. Proper risk management and position management will help you avoid getting into these situations. The next important concept we want to introduce to you is real leverage. This is different from the leverage rates we discussed earlier for different currency pairs. Real leverage is the leverage for your entire Forex account. Here is a formula to calculate it. It equals to the open lot size divided by your account balance. Let's take a look at an example. Let's say Lisa has a balance of $10,000 in her Forex account. She currently has a one-lot long position for a USD to CAD currency pair. This currency pair has a leverage rate of 100 to 1. So, what's the real leverage rate? 100 to 1? No. The real leverage rate equals to the open lot size, that is one lot, $100,000 divided by the account balance, that is $10,000. So the real leverage is 10. In this example, both currencies used in this equation are USD. But if Lisa has other currency pairs such as Euro to USD, while the base currency is Euro, then we must convert either the one lot Euro into USD or the balance USD into Euro. The basic idea is that we must use the same currency to calculate real leverage rate. Let's revisit the previous margin call example. What's the real leverage rate when Lisa opens 9 lots of USD to CAD in her Forex account? By applying the same formula, her real leverage rate is 9 lots, that is $900,000 divided by her account balance, which is $10,000. This equals to 90. 90 is actually a very high leverage number. You can see from the equation that the real leverage only relates to the open position and the account balance. It has nothing to do with the leverage rate for the currency pair. Real leverage rate is an important concept in position management as it helps us evaluate whether the amount of position open in your account is healthy. There is no real or universal standard of how many positions a trader should have in his or her account. The general idea is that a healthy real leverage rate should be between 2 to 10. Let's see how we can utilize real leverage to manage positions. Let's say Lisa has a Forex account with $10,000 balance. She also has one standard lot of open position in this account. She wants to open a new position of 0.5 lot, but she's not sure if she should or not. To help her make a decision, we can calculate the real leverage first. This equals to one lot, that is $100,000, divided by her account balance, which is $10,000. This gives a 10 of real leverage rate. Because healthy leverage rate should range between 2 to 10, Lisa is better off not opening this position. We can also use real leverage to calculate how many positions one can have in her or his account. For instance, Lisa now has a Forex account with $50,000 balance. How many open positions can she have in order to keep the account healthy? By applying the healthy real leverage rate of 2 to 10, we can arrive at 1 to 5 lots. So with $10 or $50,000 account balance, Lisa can open 1 to 5 lots to keep a healthy account. In the previous lecture, we discussed how we can use risk management to cap our maximum loss per trade. So why do we need position management also? This is because even if we can cap the maximum loss per trade, it is impractical for us to handle too many trades together. Suggested leverage rate or the real leverage rate will help you keep trades between 1 to only a few, and therefore you have less stress, more confidence, and more likely to succeed. What if I only trade one position at a time? Do I still need the 2 to 10 real leverage rate rule? The answer is yes. This is because you will not know how to set the stop loss at a reasonable range without this rule. You may set it at too small for it to hit too easily. The real leverage rate will help you set a good stop loss for you to be successful. Here is what we want you to remember from this lecture. Avoid margin call and stop out process. Utilize real leverage rate to manage your positions. The formula to calculate real leverage rate is open lot size divided by the account balance. As a rule of thumb, the suggested real leverage rate should be between 2 to 10. Risk management protects you in individual trades, while position management protects your account as a whole. In the next lecture, which is the last lecture in our Forex trading series, we will share with you some practical rules of Forex trading. I hope you enjoyed this video. For more educational materials, visit us on www.marketnewbie.com or our Facebook page and Instagram page. See you in the next lecture.